In this video, we are going to show you how to trade news the right way. Stick around to the end to learn about our favorite strategy for news trading. So, to start off, let's go through some of the most common ways that traders typically trade the news. The first one would be they tend to try and predict the move before it actually happens, and they do so using technical analysis. The second most common method would usually be trying to predict the move before it happens. Is it going to go up or down post CPI, for instance, using fundamentals. A third very common method is using the double pending order method, where a trader will place a pending order above and below price right before the news event happens, with the hope that the spike would trigger the order and take profit on one of the two orders, regardless of which way the price moves. Another very common method would be to ride the move, so effectively to wait for the spike to happen and then place an order and ride the momentum. And then we're also going to reveal our favorite strategy for trading the news, which tends to present the best risk reward. These are generally speaking in order of worst to best. And now we're going to go through each of these methods in detail. Starting off, probably the most common method that traders like to do when predicting which way price will move is to use technical analysis. In our opinion, using technical analysis to predict a fundamental move is inherently quite flawed. Don't get me wrong, I'm a big believer in technical analysis. A lot of our bots are based on technical analysis principles. But to justify this reasoning, it might be helpful to explain what technical analysis really is. Technical analysis is the study of market data, be it price, or usually price and volume, or the order book, for instance, to predict what's going to happen with price. So you use market data to predict price. And because of that, it generally works really well at predicting moves caused by the market, right? You're using market data to predict what the market is going to do to price. And to give you an example, if you're looking for a supply and demand imbalance in the order book, using this to predict that price will move a certain way can be a very effective method of technical analysis. Essentially, technical analysis is phenomenal on short time frames when you're trying to predict a market-driven move. And this is why impulses or pullbacks and these very much like market-driven moves, which are caused by the buyers and sellers in an auction process, it works really well. However, news is clearly a very fundamentals-driven event. You could argue that everything is priced in and generally speaking, the market's hypothesis is already baked into price. But really, the thing that's going to move price in a news event is going to be whatever fundamental data comes out. So trying to just look at a chart and use that to guess which way price will move, it's about as good as flipping a coin. It might give you some sort of indication, but it would not likely be the best way to trade the news. To give you an example, here's a chart from last Friday's NFP event, and you can see that price is effectively moving sideways. And then there was a huge spike downwards on gold, and then a spike back upwards. It would be very hard to argue here that you could read price and it could give you the indication of where the gold price would go. I don't think the chart shows you that NFP came in way higher than what anybody was expecting. It's so hard to see that just by looking at price data. Therefore, this is likely the worst contender of how to trade the news. Please don't try and read the chart pre-news event to guess which way the spike will go. Likely, it won't end well over a long, big sample size. Moving on. We can now talk about using fundamentals to predict which way price will go. This is ultimately a much better method. Usually, depending on where the economic metric lands in relation to the consensus, the market will react accordingly. So for instance, let's say if we're looking at the table in front of us here, if NFP, for instance, came in way more rosy, so far more jobs created than the consensus was expecting, you would typically see a very bullish event for the US dollar or a very bearish event for gold. And that's exactly what happened here on this NFP event. Therefore, if you're able to gauge or estimate before the news event happens where you think the event will land in relation to the general market consensus, that can give you a much better inkling of where price would go. And this is just a poll from RBC's economics website in which they are giving their forecast in relation to what the consensus would be. This particular example doesn't have a consensus, but we could say, for instance, this number next to the RBC 6.7 could very well be 6.3 or 6.5 or whatever. And based on where the ultimate real number lands in relation to the forecasted consensus, this can give a very strong indication if price will go up or down. Therefore, the method here would be you as a trader can form your own opinion on if you think any sort of economic event will either beat the consensus or come in below the consensus. This is a way that many more fundamentals-based traders would look to trade the news. The unfortunate thing here is it requires a very different skill set. Many professional economists don't get the prediction right. And even if you do get the prediction right, you don't know if the market was perhaps expecting something else and how it would react. So this is a method which can very well work. However, it's quite complex and you really have to have your own solid knowledge of economics to be able to do so. Maybe to give a quick tip here, as we have personally used this method in the past, what I find typically works well is find a series of economists who you find to be very trusted, very accurate, and who generally put out good results. I'm Canadian, so I like to use the big five Canadian banks, RBC, Scotia, TD, etc., and essentially look at their consensuses or their prediction relative to the consensus prior to a news event. So let's say NFP is on a Friday. The Friday before that NFP, all of the banks will put out their economic forecast as to where they think the number will land in relation to the consensus. And then it's as simple as taking a weighted average of whatever sources you like to use and using that in relation to the consensus to give you an idea of where price will go. So let's say RBC, National, and TD all think that NFP is going to be more bullish than the general market consensus. That could give you an idea that the US dollar will likely be bullish, and inversely, gold will probably go down. But if all of this is sounding complicated, is because it really is quite complicated. And even myself, who's been trading for years, it is a more challenging approach to take. And that's why this would not be our least favorite method of trading the news, but it's definitely a very challenging one. Moving on, we can look at the double pending orders approach. This is also a very popular method of trading the news. It's as simple as placing a buy stop above the range before the spike happens and placing a sell stop below the range before the spike happens. The premise here is that traders are hoping that price explodes very cleanly in one direction, triggers a buy or a sell stop order, and then it rapidly takes profit as it surges. This method can be very, very risky because of wicking. So here's an example of just unemployment claims release, so a relatively small news event. But you can see that before price went down, there was this quick wick to the upside where it would have triggered your buy stop, it would have then triggered your sell stop, and then gone down. And I chose this example as it shows an illustration of where you could have triggered both orders and also stopped out both orders because it first went up before going down. So the danger with the double pending order is if your move is not clean, you can have a double loss because it can both trigger and stop out both of your pending orders. And as news events also happen to have extremely high spreads, those spreads are working against you. So even if one of your orders does enter profit, it could be so heavily slipped due to the widening of spreads in these high volatility news events, you could still end up losing money. So you have to be extremely, extremely careful with this method. Generally speaking, how we like to trade it is if it's part of an existing strategy, for instance, our time bomb, which would place a collar of buy and sell stop orders around the pre-market range, and it just so happens to occur during a news event, great. It's part of the strategy, it's been back tested, and in our back test we did not filter out news, therefore we can run it. But I would strongly recommend against purely hunting for news events with a strategy using a double buy sell stop, as the risk is simply too high. And more often than not, during these high volatility events, you get wicked out and it's just not worth it. But if it's part of an existing strategy and you've back tested with news events, you can let that strategy continue to run without using a filter. Moving on, we can now discuss riding the move. So here I pulled an event from this NFP on Friday as well to give you an illustration. Essentially, how this works is you would wait for the initial impulse and then you would enter on a continuation, often using pending orders. At Prosperity Algo, we have our missile bot, which does trade impulse continuations, and quite often it will enter in these events. And as you can see here, this was missile, and it did precisely that. It detected the large impulse from NFP, it placed a pending order, and it quickly took profit. This actually works very well, but it has to be done very strategically, and I would be very hesitant to do this in a non-algorithmic way. So riding the move can be a good approach, but you have to be extremely fast. You likely have to be very mindful of spreads. So I would be very skeptical of doing this manually. However, it can work extremely well algorithmically, as you can use a spread filter and a computer is far faster than any human can be. And now, the final slide is the best way of trading the news. And in our opinion, this would really involve trading the pullback. So a pullback would refer to, let's say there was a huge spike upwards, as we often see in these news events, but there was a rapid rejection at the level and price started to continue back downwards. The premise here is that using pending orders, you would be able to capture the move back down. And the reason why this approach is quite solid is when price starts to pull back, often spreads have already normalized. And because you're not chasing the initial direction of price, you're buying on a pullback, usually you will get filled at a better price because you're not fighting to be part of that initial group of buyers or sellers who's trying to ride with the news. You're buying typically at a better price. And the general premise here is that, especially in these high volatility events where there's insane amounts of order flow, markets do tend to overreact. And especially quite often in these NFP or CPI or these big events, the initial reaction is not what ends up happening. So we can go back to our NFP. You can see the initial direction was downwards, but then it very rapidly shot to the upside. So the initial reaction of the market might not be the true move. And this is why we like to trade the pullback, and we do this using our seeker system. Let me quickly go over to MetaTrader to show you how this is done in practice. Okay, before jumping into MetaTrader, I actually thought it might be helpful to show you how one of these strategies would work on TradingView. So this would be an example of our seeker system, which is trading the aforementioned strategy of the pullback from an impulse. This is the famous NFP example from this Friday, where we saw the initial giant push downwards. However, Seeker would not have traded the initial move down. It would have instead placed a pending order at the initial pullback, and when price would have then continued and reversed, then it would have taken significant profit. We can actually run a back test here using every tick based on real ticks, just to see how an equity curve implementing this strategy would look. I'll press play real quick, and hopefully this loads relatively quickly. Perfect. We can see it running here, and as you can see, perhaps if we slow it down a little bit, it is looking for impulses in the market and trading the pullbacks. There we go. Perfect. I will just minimize it so we can look at the equity curve. As you can see, over 1 year, this would have made approximately a 30% return, risking only 2% per trade. You're also able to toggle it for higher returns or lower returns given your risk preferences. If you're interested in checking out our Seeker system, which implements this strategy 100% automatically on your behalf, I invite you to head to our WAP page, which is linked in the description, and you can actually sign up for a 7-day free trial of our Golden Seeker system. Not only can you run back tests, you're also able to test it on a demo or on a small live account to see if it fits with your trading objectives. Please let me know in the comments if you had a chance to download it or if you have any feedback or any questions. Thank you and take care.